not working. It is a disaster. It is a failure. And the fact that so many Americans are having to rely on their dwindling real paychecks to put food on the table or pay the rent is more proof that the economy is much weaker than we're being told.
In today's video, Peter Schiff, founder, CEO and global strategist of Euro-Pacific Capital, gives a warning that the 2008 crisis was just the prelude to a larger sovereign debt crisis in the United States that may lead to a collapse of the US dollar.
So the market, in general, the markets were stronger today, ignoring what I believe to be more bad news that is raining on this everything is awesome parade. I was listening to guys on CNBC today talking about, this Goldilocks economy, not too hot, not too cold. Everything is perfect. We're returning to a slower growth, low inflation economy. We're not going to have a recession. We're just going to have slower growth, but that's okay because we're also going to have low inflation. It's going to be just like it was for the 10 years or 12 years following the 2008 financial crisis, right up to COVID. It's the perfect environment. And so you should just buy stocks because, everything is awesome, but nothing is awesome. And the data actually bears this out. The problem is so few people in the mainstream seem to understand this. I mean, maybe they, just have a powerful reason not to understand it. Maybe their livelihood depends on them not understanding this. And so they don't. But let's take a look at some of the economic data that I think is being misunderstood and ignored. One, with the jobs numbers. We got that today. This is the big number that everybody looks forward to throughout the week. You got the official non-farm payroll report for August. Now, one of the interesting factoids about this report is every single report that we've had has been downwardly revised the following month. It was 6 for 6. And I commented last month that there was no way that was random, that if it really was just random and that sometimes the government was too high and sometimes they were too low, maybe you'd have 3 downward revisions and 3 upward revisions, maybe 4 and 2, 5 and 1 would be pushing it. But 6 out of 6, was a pretty good indication that it wasn't random, that the Bureau of Labor Statistics, they were just biased and they just thought the economy was stronger than it was. And they just assumed jobs were created that weren't. And then when they got more data that kind of contradicted their rosy vantage point, well, then they revised down. But, the markets get the initial number and it's like, yeah, this is great. It's better than expectations. And they ignore the fact that a month later, they find out it was actually lower than expectations. Well, the same thing happened again today with the July number. The July number that was originally reported at plus 187,000 was revised down 30,000 to 157,000. So now it's 7 in a row where we revised down. Again, try tossing a coin 7 times and see if you can get heads all 7 times, right? How many times you're going to have to do that before that happens? It's not easy. So again, this is not random. And I'm willing to bet that next month, today's jobs data, which came in above expectations, is going to be revised below. What everybody was looking for August was 170,000. And we ended up with 187,000. So it was a beat. But if we end up revising it down next month, it's probably a miss, which has been the case with every single jobs report so far in 2023. Now, another, sign of weakness was a pretty big jump in the unemployment rate of 3.8%. It was 3.5% the prior month. And the expectation was for it to hold steady at 3.5%, yet instead we jumped to 3.8. So that's a pretty big rise, One reason is more people came into the workforce. Labor force participation rate rose from 62.6 to 62.8. Obviously, a lot of the new entrants weren't able to find jobs. So they're in the labor force, but they're looking for jobs now. They don't have jobs. And so now they count as being unemployed. They didn't count before because they weren't employed before, but they weren't looking. Now that they're looking, they're part of the official number. Private payrolls, though, rose more than expected, but again, were downwardly revised in the prior month. Manufacturing actually had a decent number. They revised the negative 2,000 from last month to negative 4, but this month was a positive 16. Now, we'll see if that holds up. I'm sure it's going to be revised down next month. The question is, will it be revised negative? It might be hard when you're starting from plus 16,000. But also, if you look at the average hourly earnings, that was below estimates. Supposed to rise 0.3, we rose 0.2. And year over year, average hourly earnings were supposed to go from we're supposed to be 4.4, and instead it was 4.3. That's a year over year. So some people might think, oh, that's good news because, it's less inflationary pressure. I don't think so. I think it's just more pressure on households because their incomes are not rising nearly as fast as their expenses. In fact, if you look at the personal income and spending numbers that came out yesterday, this bears that out because July personal income rose less than expected. I think it was supposed to rise by 0.3, and instead it only rose by 0.2. But spending rose more than expected, 0.8. Now, again, these numbers are not adjusted for inflation. And so what I think is happening is when spending is up 0.8, again, it's not because Americans are buying more stuff. They're probably buying less stuff. They're just paying more for what they buy, so that net they are spending more, but they're spending more and getting less. Now, there is like a deflator in this PCE, right, that's supposed to measure inflation. And according to that number, incomes are rising more than prices, but the number's wrong when it comes to determining prices, because the PCE is the most flawed of all the official inflation measures because it's the most rigged. It has the most hedonics and substitution and all this, monkeying around. That's why the Fed likes it, because it's the one that's the least honest about how high inflation is. So if they want to pretend inflation is low, they could point to the PCE. But I'm sure if you adjusted the income and spending numbers by actual inflation, not the government's version of inflation, it would show that incomes are growing slower than prices are rising. And that is one of the reasons why Americans have to dip into their savings, which, by the way, the savings rate collapsed to 3.5%, one of the biggest monthly drops in the savings rate on record. This is the lowest the savings rate has been ever since it's shot up because of all the stimulus checks that were mailed out during COVID. So Americans had, that lifeline, and they're running out of rope here as the savings pool is getting shallower and shallower and shallower. But this tells you two important things. One is that the consumer is in trouble. You dip into your savings when times are tough. When times are good, your savings are growing. You're adding to your savings, right? You save more when you're flush. If you have extra income, if you're doing great, that's when you add to your savings. When do you tap into your savings? When you need the money, right? It's like you have a rainy day fund. So while the sun is shining, you put deposits into your rainy day fund. And then when it rains, well, now you have a fund that you could withdraw from to get you through until the sun shines again. So the metaphor is when times are good, you sock the money away. And when times are bad, well, you have something to fall back on. Well, if Americans are falling back on their savings in a big, big way, what does that tell you? Times are hard. Contrary to what the Biden administration is spinning, Bidenomics is not working. It is a disaster. It is a failure. And the fact that so many Americans are having to rely on their dwindling real paychecks to put food on the table or pay the rent is more proof that the economy is much weaker than we're being told.